There are a number of founders in the portfolio whose companies probably should have already shut down, but they are resilient. They know what they signed up for. They cut their salaries to extend burn. They've figured out all sorts of ways all voluntarily, to extend runway, to give themselves another chance at figuring out how to turn over another card and see if can they grow fast enough to raise another bit of capital and extend runway. And if you're going into healthcare, if you're going into climate and energy, going to education, these are like very fraught, regulatorily complex industries that you're attracted to building in, probably because of some like deep-seated personal mission-centric reason. And so probably less likely to throw in the towel or give up.
Hey everyone, welcome back to the Ignite podcast. Today we're thrilled to have Adam Besvinick on the mic. He's the founder and managing partner of Looking Glass Capital, a pre-seed firm known for being the first yes for mission-driven founders. He's invested across the earliest stages of company building, worked with iconic seed firms and later stage funds, and has supported founders solving challenges across health, climate, and economic drivers. Thanks for coming on, Adam.
Thanks for having me, Brian.
So we were giggling before about this trauma question, but I'd love to know what your origin story is, and what do you think the trauma that is driving you and shaping you?
I think maybe ultimate sort of first world problem is I don't fortunately have too much trauma that's driving me to build a venture fund. Origin story wise, I've kind of been surrounded by small business entrepreneurs and founders since I was growing up. My grandmother ran a small business. My father ran a small consultancy. These aren't startups in the sense of the types of companies that you and I fund, but I've kind of been surrounded by entrepreneurs from the time that I was quite young. And so seeing that type of drive and the dedication that it takes to start a company was something that I saw firsthand from a relatively young age. And so I don't necessarily think that's the reason why I became a venture capitalist per se, but I do think it is a really important part of my upbringing in terms of wanting to be surrounded by these types of inspiring individuals who want to build something from scratch and sort of control their own destiny to a degree. As far as sort of like origin story in venture, it doesn't feel all that dissimilar from a lot of sort of peers who tried to network their way into this ecosystem when it's sort of, very relationship driven and relationship centric, and it's an overused term, but you're trying to like hustle your way into conversations and meetings and coffee chats. And I was fortunate enough years ago at this point, which feels dating myself, that 14 years ago, I was out of college, but I sent cold emails to literally hundreds of VCs and was active on, very active on Twitter when Twitter was a different place, trying to get in front of investors to figure out the best way to network my way into this industry. And unfortunately, a lot of people got coffee with me and got on phone calls with me and took the time to share their advice and experiences. And one of those people was Chris Sacca, who started Lowercase Capital and has since gone on to start Lower Carbon and has probably the best seed track record of all time, the best seed fund of all time. And I ended up working remotely for Chris when I was in business school from 2011 to 2013. And that was a role that I got with Chris, in a relationship that I started with Chris that came off of a cold email to him. And so that was sort of my foray into venture, and was working 10 to 15 hours a week remotely for Chris for 2 years while I was in business school, and just trying to soak up as much as I possibly could from the way that he worked with founders, the way he thought about making investments, the way that he thought about reputation as really was like one of the first truly solo GPs when he started the fund. Nobody called it that, in 2010, 2011. And so I'd say that's my like venture origin story, or more proximate origin story, which is sort of the way that I was able to sort of network my way into this industry and sort of parlay that relationship with Chris and what I learned from him to eventually start my own firm.
Yeah. So you're at grad school, and how did you come up with Chris's name? Like, it's just like, did you read a case study and you're like, oh, that's who I want to be like, or you just kind of knew of him? Or
well, I joined Twitter as a user in March of 2009, which now feels quite early for joining Twitter.
My first tweet is like around the same time, and it's like, why is nobody here?
The feed on Twitter in 2009 was literally every tweet in the world, because there was so little content that they couldn't just rely on you on people you followed to populate your feed. And so I ended up following a bunch of VCs and tech people that way. And I really I remember tweeting back and forth with people with VCs who, I had 120 followers or something, and investors were actively engaging on the platform and using it, and obviously in a very different way than Twitter gets used today by investors. And I ended up emailing Chris February of 2010. So I hadn't even gone back. I knew I was going back to school, February 2011. I knew I was going back to school that following fall, summer. So I wasn't even in school yet. And I was basically reaching out to investors to say, I'm going back to business school. I want to end up in venture 2+ years from now. How should I optimize my 2 years of business school if I want to end up in your seat when I graduate? And everyone had a different answer. Most people said, don't go to business school. They said, take that money and go start a company or basically do anything else. Some people had, basically everyone thought that their path was the right path. And that there's really no one path to getting into venture. Sort of stumbled upon Chris through following him on Twitter and seeing how he, and he was obviously, Twitter's biggest fan outside of Ev and Biz and Jack. And so he just sort of like fell in love with how he talked about the product and how he used the platform. And I sent him a note and said, basically the same thing that I was telling other people. I want to get into this field after I graduate. And he was kind enough to respond to a handful of questions I had. And I then said, like, hey, if you ever need any help, sort of someone help you part-time or as an associate or whatever, like, I'd love to. I'm raising my hand right now. And he ended up reaching back out to me about a month and a half after I started school and said, hey, I have a portfolio company that could use some help. You're top of mind for me because, we've been interacting on Twitter and email and whatnot. It's a portfolio company that needs some support. And if you want to work on this project with me, I think you could be useful to them. And it turned out to be Twitter. And so I ended up working on this project with Chris, and he said, we'll just treat this as unpaid. I'm not going to interview you. I've read your tweets. I've read like the blog posts you've wrote. And if you screw this up, then I should have done more diligence. And if it goes well, then we can talk about something more formal. I ended up working on this project with them for a few months, and it went well enough that he was like, I'm happy with the work you did. Twitter's happy with the work you did. Here's a Lowercase email address. You can go to demo days on behalf of Lowercase. I'm raising a new fund. Do some research that sort of underpins my investment thesis. Send me deals and companies that you think are interesting. I went to South by Southwest, representing Lowercase. I went to Techstars demo days. I went to 500 Startups demo days. I, got sort of unparalleled access to, at the time, stuff that I never would have been able to go to as a regular business school student. But now all of a sudden I'm like, unpaid associate intern for Chris. And so I, got to interact with tons of people and meet tons of founders and stuff that I never would have had, the ability to do if I hadn't gotten that opportunity.
So cold emailing works, turns out.
I've gotten LPs through cold emailing. I send cold emails every day. I've funded probably a dozen companies off of cold emailing.
Yeah.
So.
No, I mean, and as VCs, we both get cold emails left and right, probably 40 or 50 a day for me. I mean,
yeah,
now WhatsApp is becoming a thing where people are reaching out on WhatsApp, and then you have Bordy, right? Andrew with the CEO is just on the pod, and like Bordy's now like reaching out to me. It was like 3 or 4 people fundraising every day. It's just a deluge,
Yes. Yeah, but I've funded probably 10 companies that have been cold inbound since I started Looking Glass. So
yeah,
still,
for sure.
Still a very useful channel when it's done well.
So what happened next? So you graduate and then you go on to Gumroad at some point?
Yeah, so Gumroad was a Lowercase portfolio company. And the summer between my first and second year of business school, I kind of sat down with Chris and I was like, what should I? He's like, don't work for me, work for me this summer. Don't do venture full time for the summer. Go to a company. And so he was like, you could go to Twitter, you could go to Uber, you could go to all these different, he's like, I have this, sort of super early company. The founder is 19. I felt like he was like, I was 25. It's not like I was like old, but that 19 felt like super young to a 25-year-old. He's like, you're not going to get any training. You're not going to get any oversight really, but you're going to learn a ton and you're going to work hard. And this is as close to being, without founding the company yourself, like you're working from his apartment. You're just going to learn, as much as you possibly can from Sahil. And so I said, great. He introduced me to Sahil. I remember meeting him at South by Southwest in Austin. It was spring 2012 before, that summer break in between my first and second year of school. I was like, great, I'm going to go work at Gumroad for the summer. So I ended up, working with him and Ryan Delk, who has since gone on to, Ryan was a summer intern at Gumroad the summer that I was there. who has since gone. He went to Omni and has since started Primer in the ed tech space. And I ended up Brian and I were doing business development. We were trying to figure out how do we get major artists and major creators onto the platform and trying to drive, sort of like notable users to monetize content on Gumroad that weren't like long tail creators. So we spent time going to, spending time with film companies and, record labels to get well-known celebrities and artists and performers to distribute content directly to fans on that platform. And we were pretty good at getting, some notable people to use it. And then I went back to school, kind of worked a little bit part-time remotely for Gumroad, ended up doing more stuff for Chris the second year of school. And then when I graduated, I moved to San Francisco and I joined a company called Wanilo, which was an early player in sort of the social commerce space that was backed by First Round and Floodgate and Forerunner Ventures. I think it was part of Forerunner Fund 1. And I joined them as like the 20th hire, trying to monetize this platform that had millions of users, but really hadn't generated any revenue at this point. And they raised, in like the winter of 2013, they raised an $11 million Series A, which in 2013 was like an enormous.
Yeah. Now that'd be like a seed.
Now, yeah, exactly. They raised like an $11 million Series A at over $100 million valuation, which in 2013 was like, unfathomable. It was like the hottest company in Silicon Valley, doing a lot of the same stuff I was doing at Gumroad, but just in a different, sort of market context. So I was trying to figure out how to get brands and retailers to use the platform to post their own content, drive traffic, get the Wanilo, if you remember, like the pin it button and like the Twitter, like tweet button that would be under images on sites. We got like the Wanilo button, like, getting a line of code embedded onto a retailer's site is a lot harder than most people might think. And so we got like the Wanilo button installed so that people could easily sort of save from Nordstrom.com to back to Wanilo. We did all sorts of in-store integrations with Nordstrom and other retailers, and it was, a ton of fun. But really for me, it was like an excuse to be on the ground in the Bay Area full time and continue to, I kind of describe it as like a third year of business school, except got paid instead of paid for it. So I was going to all of the standard sort of like coffee shop haunts to meet with VCs before work and trying to continue to build relationships with other firms and founders and operators. And while I was there, I ended up meeting Tim Kamada, who was the founder and managing partner of a small fund called Deep Fork. And that was sort of my path to go from sort of the startup side, working on the BD side of things at Wanilo, to moving over to venture full time. This was the summer of 2014. So basically a year after I started at Wanilo, moved over to the investing side at that point.
Yeah. So you probably get young 20-somethings reaching out to you all the time and asking you about getting an MBA. Should I get an MBA, or should I start a startup, or should I go into VC? I get these questions a lot because, I haven't, like you, have an MBA and I've done startups in VC, right? So I get these questions all the time. I've actually had a lot of interns that come through Team Ignite and even get into an MBA program and decide not to do it. So how do you help young people think through whether or not to get an MBA, like in like 2025, 26?
I think it's a really challenging question that is very specific to the person who is asking it, right? Like if you went to an awesome school and you work in tech, there's kind of not a lot of reason to go back to business school, because you should probably have enough of a network and set of relationships and on paper track record to move into another area within business kind of broadly. If you've never worked in business at all, right? Say you're a mechanical engineer and then you went and you worked in, the automotive industry, as an engineer for 3 years or 4 years, and you're like, like I want to get into quote unquote management. I want to, sort of transition out of this field. Then yes, I think like leverage it, going to a great school and using those 2 years to, one, learn some stuff that you just don't know, and two, build a set of relationships and network and use that as a transition and pivot period, I think is super valuable. But, if I think about myself, I had done 2 years of investment banking as an analyst, and I went right back to business school after 2 years. I probably in 2025 could have taken those 2 years and gone and worked at, taken my analyst experience and gone and worked in big tech or a late stage private company for a couple of years in some sort of BD corp dev role, and like gradually moved over to venture, right? Like if that was the, sort of the destination. And so I think I have a stronger opinion on what you should do after school directly. Like, I think a lot of people are like, oh, consulting and banking is a waste and it's going to be replaced by AI. But like going and working in banking or consulting for a couple of years as like an analyst is like amazing training. You're given way more responsibility than you probably should have as a 23-year-old. You learn how to have attention to detail. You learn how to take on, like, you learn how to work really hard, like all things that you like kind of can't just pick up, organically. And so I have more of like an ardent level of support for that path right out of school than endorsing going to business school, depending on like what you did.
Let me ask you this. Do you think you'd be in venture if you didn't go to business school?
I say maybe. I mean, I think like being as a student, you're harmless. So people will respond to cold emails way more when you're a student than when you're a professional. And actually, I used my personal Gmail address. I didn't use my business school address to reach out to people. But obviously, I mentioned like I'm a student in school. You can see on LinkedIn if you click through a link, he's a student. Like he's innocuous. He's not trying to take my job. He's like, there's just like a level of help that you get as a student that you don't get if you have a real job and you're trying to like catch up with people or get coffee or pick their brain about something. And so I think way more people responded to my cold outreach because you're this dumb student who doesn't know anything than like you're in the working world. I think, could I have made the transition to venture as like, oh, go work as an associate at some firm after 2 years of banking, some sort of growth stage type role, and then gradually move my way to early stage? Yeah, probably. But I don't necessarily know that the path would have been it may have been a little bit more circuitous if I hadn't gone back to school.
So you became an operator at a couple companies and then you went into venture. Tell us about that transition and what led to, ultimately Looking Glass.
Yeah, I mean, I hesitate to say I was really an operator. I mean, I had like a summer job at Gumroad where I worked a ton and learned a ton, but like, and then, I had a cup of coffee basically at Wanilo. But I mean, all along, I really wanted to do venture. I always wanted to invest. And so when I met Tim at Deep Fork and he was looking to bring somebody on more junior and I didn't really like living in San Francisco at all. So he was an SF and told him I wanted to, if he wanted to hire me, I really wanted to be in New York. And he was looking for someone to be on the ground in New York. Then that just like worked out perfectly. And so I moved to New York that summer, and then I ended up spending a week every month in San Francisco for the next nearly 3 years. That was sort of the condition that I had with Tim and the firm, which was like, I will come here Monday through Friday, 1 week every month to meet with companies that are here, source deals, build relationships here, obviously spend time with you as the managing partner in GP in person. But like, I want to live in New York City. So timing was really fortuitous. Like a lot of roles in venture, like it just kind of like falls in your lap to a degree, like just kind of like happens. And so,
I mean, you're one of the lucky ones to actually land a role. I spent months trying to find a role myself, and I had to just create my own firm.
Yeah, I mean, look, it's a flaw in venture, in my opinion. If funds portfolio companies were managed from a people perspective the way that funds are, then like every founder would be fired, right? Like most funds are really bad at people management and training and hiring and and sourcing talent. And as we can see over the last few years, they're also really bad at figuring out ways to retain talent.
This rise, I think, of, AI is making us all more efficient. We see it on our portfolio companies. And I think it's making us as VCs more efficient as well. And so I think the AUM per partner is going to go up in the industry, just like kind of the ARR per employee is going up in the tech industry, because you're just much more efficient with AI now.
Yeah, well, I do think that there will be fewer and fewer junior roles, but I sort of struggle with this idea in a bunch of fields, whether it's law or consulting or banking or venture, which is, okay, so if these junior roles are being dramatically sort of cut back because I can use AI to do the job of an analyst, like where do the VPs and managing directors come from if they don't come from people who grew up in the industry, learn how to do the job?
I think it's a great flattening of organizations, right? Because if you look back at like, kind of the Mad Men days of the 50s, 60s, right? You had basically a spreadsheet laid out on a floor and people are just kind of, doing everything by paperwork.
Yeah.
And it just required a huge bureaucracy and hierarchy to kind of get work done. And I think technology has like flattened organizations over time. And I feel like AI is going to be the ultimate flattener, where like maybe the company of the future only has like just a C-level team, 10 C-level execs that run every function, and it's just agents and AI underneath. That might be an extreme, but what I think will happen is you'll actually get more companies, and so there'll be more VC firms, more companies, more startups, and I think we're seeing that. So my thesis is like there's a great flattening that happens with just less hierarchy.
I agree to that to an extent, but I think like in venture, like there are just so many things that you can only pick up from doing this job and having like tons and tons of reps that goes well beyond like the analysis or like the amount of people stuff that goes on, right? Like
Especially at the pre-seed level,
it's
like
at the,
what
yeah,
we do, like we're really evaluating people.
evaluating people and helping them navigate really like people-centric challenges in their business and who to hire and how to let somebody go and how to remove a founder because they're not pulling their weight. You kind of knew that all along, but now it's coming up, right? Like it's part of, why I really think that, like this job is really like kind of like pseudo psychologist in a lot of ways. It's also why I like struggle with like I would be way worse at this job as as like a founder of a firm if I were 26 versus 38. Right? I just think that there are so many life things that I help founders navigate and think through that I would be like woefully unprepared to talk about, discuss, be helpful with if I hadn't had those experiences myself in my own life and own work experiences, et cetera. And if you're sort of extremely hands off with a company, then you probably don't have to think about this at all. But like if you run a concentrated portfolio and part of your, sort of approach is to like be immersed in, and helpful to these companies, then like I don't think I would be able to do the job the way that I do 10 years ago, 12 years ago, compared to the way I
That's
do
why I
now.
usually, when I talk to people in their early to mid 20s, I tell them to go get a job basically, or start a startup, because there's just so much life to live to build up all the context. I think about what like, and I'd love to hear this for you, but like what makes me an interesting GP, I think, is because of all my lived experience. I'm in my mid 40s now. I've had multiple careers across like Wall Street and marketing and product and a variety of things. Failed small businessman, failed at lots of things, probably had 100 jobs in my life, right? So it kind of makes me like this really awesome generalist because I've done a little bit of everything, like every little functional area of a company. But you can't get that context without taking all your lumps professionally.
I completely agree with that. I also think that there are a lot of like interpersonal dynamics that emerge in this industry that you don't know how to navigate if you've never seen it like as an apprentice in a fund or in other business contexts. Like the dynamics on a cap table that can get messy and how to help a founder navigate those, right? Like the hard conversations that need to happen between investors in a business or between a founder and an investor. And if you have never done this before, you're a founding GP of a fund and you're 25 years old, right? Like I just think that you aren't sufficiently prepared to navigate these challenges. And I also don't necessarily
unless you started at 17 and exited one or two companies by 25, then maybe you are qualified.
maybe, yeah, maybe. But I also think like other funds respect firms or think about firms differently when they've seen who that GP is and how they've acted in a variety of contexts and are a known quantity. And I've just seen this play out again and again across companies I invested in at Deep Fork and Anchorage before starting Looking Glass, and now over the last 5+ years of running my own firm and over 50 investments, like, and co-investing with the same firms multiple times, you start to see patterns emerge. And these are things that like only come through reps. No AI can help. No AI is going to know, how did this firm operate behind closed doors when they needed to write a bridge check? Did they do it? Yes or no? And why did they do it this time and not that time? Right. And these are the types of things that thankfully, I don't think this job is going to be replaced by Bordy anytime soon, despite his.
No offense, Andrew. We're rooting for you, buddy.
Despite the oversubscription to the fund.
Love that. So looking back, I mean, you've been around this for 15 plus years. What are some of those lessons that you've learned that, you'd like to impart upon the next generation of emerging managers?
I think that there's been a lack of sort of like patience, and it's not just emerging, it's not just emerging managers. It's like a lot of
LPs are really
LPs and GPs and other people. It's more of a reflection of how things have changed since I started doing this job, really like full time in summer of 14. Just like this is supposed to be like some of the most patient capital. For whatever reason, it feels like there's been a disconnect.
Well, I was at a family office. It's funny you mentioned this. I was at a family office event, kind of networking my way through the crowd, and everybody's dressed up. It's in Miami, and I'm like in jeans, and I did wear a polo. So for me in California, that's pretty dressed up, and I'm talking to people. I'm the pre-seed, VC from California. And they're like, oh yeah, but yeah, early stage, nah, that's like 15 years. Like I was like, yeah, but the asset class has the highest like returns long term. Like you just look at any study. Yeah, but we'd like liquidity in like 5 to 7 years. I was like, okay, like And there's this short-termism, I think, happening,
Yeah, well, I think it's both like liquidity short-termism, but also like markup, traction, progress short-termism in a way, where like there's this sort of misalignment that if something doesn't get big quickly, like it can never get very big. And that's just been proven again and again and again to
Yeah,
not be
sometimes you wallow for
the
3 or
case.
4 years like Notion did. I think Airtable did that.
Yeah, like there's these, and so, I think
I think Figma didn't grow for like
Figma
3 or
took
4
quite a
years, right?
while. Monday.com took quite a while. Stories again and again of like these companies struggling to find product market fit, and they're really needing to like tinker with what they're working on before it catching on. Then you have obviously over the last 12 to 18 months that we all have seen the chart where like at a certain point the line's just going to go vertical. Someone's going to be at $100 million in ARR in a week.
Kind of the lovable,
The lovables and
the
cursors, et cetera, of the
cursors.
world.
Yeah.
I think that these companies they're basically giving other companies the company equivalent of like body dysmorphia. Like some of these things are just not realistic, right? It's like looking at, a Kardashian and thinking that that's like what a human body is supposed to look like. Startups are meant to grow at an unnatural rate, and you raise venture capital to grow at a rate that is not what a normal company is supposed to do. But I think we've kind of lost sight of like what a really great company can look like.
Yeah.
And the fact,
triple, double, double has become like the 10x, 10x, 5x, 5x, 5x.
right. And I just think that if you're an early stage investor, you knew what you signed up for, right? Like ignoring the LP conversation, but like the sort of the GP fixation with like, oh, well, it's not growing fast enough for me. They only grew how much this year? They only grew 5x, 2 million to 10 million. That's not fast enough for me. And I think that it's doing a disservice to, frankly, a lot of founders who are building stuff that's really valuable and is going to be really valuable. But there's sort of the number of funds that are willing to look at some of these companies is dwindling. And then the funds that do now feel like they're being adversely selected because, well, why did I get a look at this? If it was so great, wouldn't name your tier one, name your top 5, top 10 fund, wouldn't they have done this deal? And so it's a challenge that I think about a lot with companies in the portfolio, and how they think about positioning and who the right investor is for them, and how do they tell that narrative, and how do they help people understand like the customers that we're selling into can't just like put down a credit card and start paying for this thing, right? Like it take 6 months for them to start paying, but they'll pay us $1 million, but it's going to take us a while to,
and they'll never rip it out. Yeah.
So
yeah, you gotta. Yeah, this is the art and the art versus science of being a VC, right? Because you have to kind of look at the painting and really appreciate all the brush strokes of all the threads of the tapestry of the startup.
I think that's a great analogy. I think that the challenge that I foresee for some companies is, to me, there's like a misalignment at like Series A right now.
Yeah, there's a weird gap right now between seed and A.
Yeah, I just feel like the universe of funds that do Series A deals is largely populated by multi-stage firms,
right?
And they need to write a check of 12 to 15 million or more.
Yeah, get 20% owner, 15 to 20% ownership
to do an A. And there's a lot. There are going to be a lot of companies that don't need to raise that much or don't want to raise that much Series A. And who writes that Series A check? There are fewer and fewer firms well positioned to invest in an old school. It's not even an old school Series A. It's like it's a 2018 Series A.
Yeah. And meanwhile, if you have companies growing very capital efficiently, I don't know what you've seen in your portfolio. I've certainly seen it over the last 5 years. I haven't been in the industry as long as you have, but you have historical context on capital efficiency in the pre-seed, seed, and A. At least in the last 5 years with AI, I've definitely seen maybe a doubling of capital efficiency. I don't know what like your back of the envelope calculation is over time.
Yeah, I mean, I don't know if I have a definitive like multiple on like how much more efficient some companies have gotten, but like I do think that there's at a minimum it's a headcount reduction, which is translating to some degree of capital efficiency. The number of people that you need to hire to ship X amount of product is just significantly lower now than it was even in 2021, right? Let alone 2015.
I just met a founder yesterday, second startup. They raised way too much money in their first one, like 20 million. And like, we're not going to do that this time. We're going to do very small rounds with, well-defined, 3 or 4x per dollar spent kind of capital efficiency. And they already bootstrapped it to almost $1 million of ARR without raising money.
Wow.
Just two guys. I see this all the time, right? Like if you can't get to some 6-figure ARR bootstrapping, I'm probably not interested. Unless it's like a deep tech and it's like long enterprise sales cycles and you're like a crack team, perfect for it, right? So there's
Yeah,
always exceptions, you know?
yeah, there are exceptions. I think there's basically no exception for having shipped something these days. Like the idea of doing investing in anything pre-product is like I'll do it, but only for an exceptional team. But reality, there's no excuse, right? Like even like anyone can vibe code something that feels like a bit of a prototype to give me a sense for what this thing is going to look and feel like, even if it's not your actual product. Before it used to be like, all right, if you can't show me wireframes, like really, like even like drawn. Now, obviously, the bar is significantly higher with all the tools that we talked about, and so there's almost not even almost there's zero excuse for not having something that an investor can play around with and you can put in front of customers to get feedback on. And it just shows a level of commitment to the idea and what you're building that for me as an investor, like the bar for me is like, if I say no, you should still be working on this idea, right? Like I think way too many founders think that if a bunch of investors pass, then it's not, that it's like invalidated. And conversely, if a bunch of investors say yes, that it validates what they're working on, when in reality they're completely, they're largely disconnected from one another.
And some of the best things kind of look weird and non-consensus as well. So a lot of investors might pass on a really good idea because it just looks too strange.
Yeah, I mean, that's, if everyone wants to do a pre-seed super early stage deal at a low valuation, then there must be, well, one, it won't be a low valuation, it'll get bid up. But if everyone thinks something is a sure thing at pre-seed sort of prototype, few grand a month revenue stage, it's probably not it's probably not going to work.
Totally. So tell us about the moment where you knew that you needed to launch your own firm.
I think sort of, well, when I joined Anchorage, which was the hedge fund that I was at after Deep Fork and before starting Looking Glass, I went there because I wanted to round out my skill set as an investor. I had done seed for a few years. In 2025 terms, it was really pre-seed. It was a $30 million fund, 250 to 500K checks, $1 million to $3 million rounds. So it was a lot. It was very similar to Looking Glass now. And I just repeatedly felt like, I had friends telling me like, oh, well, what you're doing isn't really investing, right? Like, true investing is writing a larger check, having to lead the round, having to price the deal, et cetera. And while I, didn't necessarily agree with that and don't necessarily agree with it now, I do think that they're obviously leading a Series A is wildly different than even leading a pre-seed round. And so I wanted to get that experience, and there was an opportunity at Anchorage to do that. And they had been making some growth stage opportunities, and they were looking for someone to do earlier stage deals. And so I joined them for about 2.5 years, made half a dozen investments, mostly Series A's. I mean, I put more capital to work in a single investment at Anchorage than I put into 14 investments at Deep Fork, right? I was doing $5 to $15 million checks at Anchorage, and I think I did like 5.3 million combined, 5.4 million combined in 14 investments at Deep Fork. So it was, tremendously different experience. You had to lead rounds, you had to source differently, you had to price those deals, and taking board seats. And I was surrounded by really sophisticated, thoughtful public markets investors who like really put me through my paces in terms of like memo writing and underwriting the deal and how do you convince large investment committee to do something. But it also got to a point where I was like, all right, I know I don't want to do this stage of investing forever. Like I missed the first money in, two people and an idea, like let's brainstorm and tinker and think about different go-to-market strategies. And hey, you don't have product market fit, let's come up with some different ideas to test and iterate on. And I also like candidly felt like and I feel this way even more so now, like if you're not at one of a limited number of Series A firms, you shouldn't do Series A investing. Like we made some great investments, and we've had a couple like very significant exits from those investments that I made. But like, in my opinion, Series A is like pure play quintessential venture investing. And it's done best by a relatively finite set of firms. And those firms see everything.
Multi-stage mega firms that have $1 billion or more AUM.
If those firms don't do it, like it's highly unlikely that what you're doing is something that like escaped their gravity. Occasionally it is, but like it's probably not. And so I wanted to take the sort of institutional discipline that I saw firsthand at Anchorage, but apply that to small fund, early stage, pre-seed sort of strategy. And I just felt like, in late 2019 when I was doing this, and started January 2020 when I started fundraising, like that felt novel to me. And then, let's ignore the few months where I thought everyone thought the world was ending. But then, suddenly you had this sort of like Cambrian explosion of funds that launched at the end of 20 and 21. And it really hasn't slowed, but there was definitely like a massive influx in late 20, early 21. And it felt like my strategy was like even more stark contrast to what the behavior that I saw from lots of, fund ones, emerging managers during that time. And so I just felt like there was an opportunity to fuse sort of like institutional discipline and portfolio construction and fund math and underwriting, but do it at the earliest stages where I felt like those things were largely like disconnected. And I felt like the positioning of the firm was one that could serve both, and my strategy could serve my two customer bases like equally well for different reasons. So like LPs who generally, not all, but like many of them want you to be more concentrated. Many of them want you to own more of these companies. Many of them want you to lead and invest with independent conviction and like sort of the tropes of, a venture.
How much of that is just traditional thinking?
I think there's a lot of merit to it. And I'll double back on it. And then the other side, the other customer base is, your founders, right? And founders don't care about my business model, but they do want someone who invests with independent conviction. They do want someone who is willing to lead. They do want someone who writes a check that really matters, right? Like disproportionate amount of my, fund size, right? Like all of these things that like demonstrate that like I 100% believe in them. This is not, a call option. Can it go to zero and still work? My fund still work? Of course. Bank, like I don't have like 5 companies in the portfolio, but it's concentrated enough that it demonstrates like really serious alignment with them. And so I felt like this strategy and this model served my two customer bases equally well, but for sort of like different reasons, right? And so I felt like that approach was more novel at the pre-seed sort of earliest, sort of micro VC fund size perspective, and felt like there was a market for that both with founders and with, and with potential LPs. And so that was sort of the elevator pitch, so to speak, when I went to market raising for Fund 1. And it's early still, it's working, but to like
coming out of the J curve now on Fund 1.
Out of the J curve on Fund 1, out of the J curve on Fund 2, well out, and sort of raising Fund 3 now. So feel like, there's enough momentum and enough changes between Fund 1 and Fund 2, where Fund 2 is ramping more significantly than Fund 1. So like things like, the lessons learned from, investing during the chaos of ZERP, still quite disciplined, but still not as, still more expensive deals than for Fund 2. But like lessons learned during that period have translated well to Fund 2, and hopefully lessons to take from deploying Fund 2 to transition to Fund 3. But yeah, to your question on sort of like concentration versus larger portfolios, I think it kind of needs to align with your sourcing strategy. It needs to align with the type of investor that you are. Like I am not the type of investor that feels like I can see every hot, buzzy deal, because to me, that's what you need. You need to feel confident that you're seeing everything that could potentially be a $25 billion plus company if you're only going to be investing a smaller amount of capital, or you're going to be investing at slightly higher valuations, or 6 of one, half a dozen of the other. That was why I think personally, I don't think I would be a very good Series A investor, even if I were at Sequoia. Like I think to me, being a great Series A investor means you need to see things that are shades of gray between interesting and compelling, and everything looks interesting basically. But like, what is truly compelling? And if you're investing at a $75 or $100 million valuation at the Series A, and that company becomes $1 billion company, which is really hard to do, right? And exits for $1 billion, like it's not that great of an outcome. In fact, it's like quasi like failure of an outcome for that multi-billion dollar fund that wrote that $15 million check, right? You're shooting for $5 billion, $10 billion, $25 billion plus outcomes. And so it's part of why I wanted to go back to this earliest stage, is because I think I'm really good at figuring out, can this be anything at all versus nothing? I don't think I'm very good at, can this be a $10 billion company instead of a $1 billion company? And there are some people that are extremely good at that. And we can name them pretty easily.
You started your career as one of them.
Yeah.
Chris is arguably one of the best.
Well, I think he was even better at like, could this be anything, right? Like that's like the first money in thing, right? Like, and I think if you own a lot less of a company, or you write smaller checks or whatever, one of the two, then you need to be really good at knowing whether thinking you're seeing something that could become a generational outcome, because that's what you kind of need to have to make that fund math work. Whereas for me, like, I think I'm much better at saying, like, do I think this could be worth several $100 million to $1 billion at some point, and $1 billion out, and like my fund math is such that $1 billion outcome returns my fund.
Yeah, I've had this discussion with LPs on the pod before, and we debate this because I'm a high volume small check investor, right? And the way I looked at it was with a Monte Carlo analysis and various probabilistic reasoning. I've written a lot of articles on it, because put my CFA brain on, my finance degree brain on, and I was like, okay, like how do I efficiently allocate in this pre-seed asset class, right? And if you look at the math of it, and AngelList has a really good study on this. Like if you invested in every deal on AngelList, you'd be in the top like 20 to 25% of all VCs, and you'd have like a 25% IRR, I think it was in the study. Yeah, there's always this push and pull between the concentration and diversified. Spray and pray, or spray and select is what I call it. It kind of fits with our thesis at Team Ignite, right? We're trying to build this network that kind of helps each other, kind of like, YC does 600 deals a year. They have the social network there with over 5,000 startups that all help each other and sell to each other and sell with each other and partner. Kind of what we're trying to build at Team Ignite. It just kind of fits my personality too, I think. So like I can see you as a GP, you want to dive deep, you want to help the founders make more concentrated bets, and that's just your personality.
Yeah, I think that it's a sourcing strategy, like sourcing model. Like, I think it would be wrong if I was like, I'm just going to write 100 checks, 100K checks, and just, be hands off, check in maybe quarterly. Like, it's the founder product, founder market fit question that like you and I think about when we meet any company, right? Like, or similarly, like, it's the founder that's been in sales their whole life, and they're like, you know what, but I'm going to do product-led growth for this company that I'm starting. It's like, well, no, you should probably play to your strength on go-to-market, which is how to sell really well. And the product-based founder should be doing PLG, not trying to do enterprise sales, right? Like, and so there is an alignment of skills and personality and background and what keeps you engaged that I think also helps inform fund portfolio construction model that I think gets overlooked.
It's interesting, like I think the holy grail of VC is like probably like a 10x fund. That would put you in the top, single digit percentage of all VC funds. And if you hit the average for the asset class at call it a 20 to 25% IRR, you're gonna have roughly an 8 to 10x gross fund. But a lot of VCs don't hit that, right? Because they're not good at picking or adding value or whatever the reason is. And so statistically, we just set ourselves up for success by investing in a lot of deals. But time will tell. Like I've never met a fund manager with over 100 in their fund that had less than a 10x fund. And that this is like dozens of people I've talked to at this point over the years. They're like, oh yeah, like Ron Conway's strategy, right? 300. I think he had like 300 in his SV Angel 1 or whatever. And I think it was a 12 or 13x fund. So it's really interesting. But yeah, it's not for everybody. It's really hard actually. I have to like do a lot of AI and automation and connecting people. It's very hard. Not easy. It's just different.
Yeah, no, it's a different sourcing strategy. It's a different way to help post investment. It's a different, the entire job looks probably very different, actually.
Yeah, no, it is. It's a lot of orchestrating and
a lot more different than people would expect.
Yeah,
even if you're title.
I asked the LP this question. I'd love to get your take, which is, if you had a fund, you're looking at two funds, right? And one fund had 30 investments, and one really knocked it out of the park, right? Returned the fund 3 or 4x over and ended up with like a 5x fund gross or something like that, right? And it had a bunch of singles and a bunch of zeros. And then you had another fund that made 30 investments, but virtually all of them were about 5x returns. So a bunch of doubles, call it. Which fund are you more happier with?
I had this conversation with an LP myself, actually, because I think that there's this view that if your attrition rate isn't, if you're not getting a bunch of zeros or less than 1x's, then you're not taking on enough risk. I think is totally reasonable if you're investing at seed and A. I think at pre-seed, it's hard for me to say that a low attrition rate means I'm not taking on enough risk, because it's all risk. Like,
it's all risk. Yeah,
it's all risky.
Startups. Yeah,
all risky. These are all two people with an idea and maybe a prototype. And
I had a VC tell me this the other day. Is like, well, if you're not getting, because I've had very little shutdowns in my career, and probably because I kind of invest like you. Like I look at founder market fit, traction, momentum, something unique, and there's a moat here. a distribution advantage. They know how to sell or do PLG, whatever it is, right? And I've like out of almost 300 investments I've made, I've only had in 5 or 6 years, like maybe 7 or 8 shutdowns. So it's very, very low attrition rate. Now there's probably another 30 or 40 in there that are the Walking Dead and they are going to shut down. But still, that's pretty low, I think.
Yeah,
When you look at a fund model, you're anticipating 50 to 60%.
Yeah, I've had 3 or 4 out of the 53 companies so far shut down.
That's very low as well. Yeah.
And so now, there's probably 2 to 3, like on my like ratio, there's probably 2 to 3, like kind of that are like, at some point they will. But like, I also think it's a testament to the types of founders that you mentioned. You underwrite, you do all this diligence, but also like there's a natural level of resilience, in my opinion, from certain founders. Like the unwritten agreement. I had dinner with a founder in the portfolio actually on election night last year. I was in San Francisco. If you ever want to make sure you get upgraded, fly on election day because nobody's
traveling.
No one's traveling. And so I flew to San Francisco on election day and I had dinner with the founder of the portfolio and she and I were talking and I said that there's an unwritten, unspoken agreement between founder and investor that makes like this whole ecosystem like beautiful and really work well, which is we give you money, basically no strings attached money. And if the company does not work, you can walk, you basically can walk, as long as you don't commit any sort of like ethical, or financial fraud, you can walk away scot-free. As long as you tried your hardest to make this thing work and figured out how to shut it down gracefully and did everything you possibly could to make it a success. Cool. Hey, there's no need to apologize. I know what I signed up for. You know what you signed up for. And I think that there is and those are the types of founders that you hope you back, right? And you don't know how someone's going to behave until like, the rubber meets the road and things get hard and whatever. But like there are a number of founders in the portfolio whose companies probably should have already shut down, but they are resilient. They know what they signed up for. They cut their salaries to extend burn. They've figured out all sorts of ways to, all voluntarily, right? They've figured out all sorts of ways to extend runway, to give themselves another chance at figuring out how to turn over another card and see if this, can they grow fast enough to to raise another, bit of capital and extend runway. And I think also the types of companies that I'm backing attract resilient entrepreneurs, right? If you're going into healthcare, if you're going into climate and energy, if you're going to education, oftentimes like these are like very fraught, regulatorily complex industries that you're attracted to building in, probably because of some like deep-seated personal mission-centric reason. And so you're probably less likely to throw in the towel or give up than maybe some other categories that attract more casual fly-by-night founders. And so, I think that there's just an appreciation for like the venture investor founder relationship that some founders have. And I think that there are a lot of founders that don't have an appreciation for it. And fortunately, like I haven't backed any, or maybe 1 or 2 in my life. And so I think that to me is also part of this dynamic.
Yeah. And part of your thesis too. Maybe you could tell the audience what Looking Glass does and what your thesis is.
Yeah. So as Brian mentioned at the top of the call, and I just referenced, so I'm investing in 3 core areas: healthcare, climate and energy, and this third thematic bucket called economic drivers, which really includes education and tools and platforms for small businesses. And so largely investing in a lot of software and application layer stuff across these categories, pre-seed, loosely defined. So generally these are round sizes between $1 million and $2 million, first couple $1 million into a business. Valuations are typically between 5 and 12 million posts, kind of hovering around like the 8.5 range on fund 2. And I like leading or co-leading out of fund 2. I have a couple more investments to make, and they've typically been about 350 to 400K checks. And out of fund 3, I'll be writing 500K to $1 million checks. But again, the same stage, same categories.
And how many checks per fund? 30. Okay. Yeah, I pulled that out of my head earlier.
Yeah. Fund 1 was a little smaller. Fund 1 was 24. Fund 2 might be 31 because there's just a little bit, there was a couple smaller in the 300K range. But yeah, somewhere around 30, I think is the right number for me to manage and get my sort of balance of ownership versus shots on goal. And it's solo GP, just me, trying to be as helpful and supportive to companies in the portfolio as I can.
Yeah. Do you have any assistants or part-time people or anything like that? Just doing everything?
Everything.
You should probably get yourself an EA at this point. At least an MBA level EA overseas or something, Athena Go or something like that.
I think that in the fullness of time, I think the model for me is a chief of staff who's like part ops, part associate, part research, part diligence,
part portfolio manager, all that.
Just a mix of basically the role that like a full-time version of the role that I had with Chris, basically.
Yeah. That's basically what I have. I have an EA that's been with me for like 4 years. I found her on Upwork. She's great. And she just I just throw stuff at her and she just gets it done. So like, great. She's half time with me, 4 hours a day. She's great. Can't say enough about my EA. Shout out to Katharina. How has fundraising shifted for you from like Fund 1, 2, and to 3? Fund 1, of course, is all just people we know, rich people we know, writing us checks. Fund 2, you start kind of breaking into some family offices. What's Fund 3 looking like? What have you learned about fundraising, asking for a friend?
I think don't start your fundraising in the throes of a global pandemic. Fund 1, that's
good advice. Or the throes of like I did my first close of my traditional fund in late 2022.
Yes. So I was not fundraising. I was fundraising for Fund 2 late 22 through 23.
Same.
Into 24.
Yep.
Yeah. So that was
2.5 years. It was a 2.5 year fundraise for a $5 million fund.
That was worse. That was actually worse than COVID.
Fund 3 I'm raising now, another like basically a $5 million fund, but I'm not even paying attention to the fundraise and I'm still kind of just raising money.
I think that the two things that I learned that I've done much better this time than I did on the prior one. One is I spent time in between fundraises actually talking to LPs. Now I send out a letter every 8 weeks to my own LPs and to friends and followers of Looking Glass. And I do that without fail every other month. So, and out of 900 people on that friends and followers list, most are potential LPs and the open rate's like 60%. So like people are looking at my updates, but there's something very different than sending an email update versus like getting on a 30-minute Zoom call or telling them you're in town and getting coffee and whatnot. I've done a much better job of maintaining relationships and sort of building dialogue in between the fundraising for Fund 2 and Fund 3. And I think that's been a huge advantage with this Fund 3 process. I think that this is true, and it's true for like these things take time, and they are largely multi-year relationships prior to someone making a commitment to a fund. Obviously, there are exceptions, and those exceptions are probably like family offices and individuals, not fund to funds or institutional, quasi-institutional allocators. And so, I talked to somebody about Fund 3, and he's like, "Oh yeah, like we've been talking for 5 years, and you did exactly what you said you were going to do. Like you could have been part of Fund 1, and then
Fund 1's doing really well, by the way. Yeah,
but yeah, I think that there's a lot of people that raise and then their strategy shifts. They start overpaying for stuff. They chase shiny objects, and I think like the bar for just doing what you say you're going to do as a venture investor, both on behalf of LPs and on behalf of founders, is like shockingly low. And so when you just show up every day and do the work, and obviously results need to speak for themselves, but like doing it in the process that you outlined you were going to do, that stands out a lot to people. And so I also think like just getting to a certain point in firm building indicates a level of success and a level of like sustainability and determination. It's the same way that like if a company's out raising a $20 million Series A or a Series B, like they have to have been doing a bunch of things right to even get to that point and to even have the confidence to try and raise that much capital, right? The same way that like if you're out raising Fund 3 and it's, oh, this was how much Fund 1 was, this is how much Fund 2 was, this is how much Fund, oh, okay. Like, right, things must be going pretty well. Like, no one's just this isn't a charity, right? Like no one's just giving you money so you can employ yourself, right? And so I think getting to Fund 3, the same way like if you get to Fund 4, right, like the level of attrition for people that make it to a Fund 3 or make it to a Fund 4 is so high that if you get to that point, like there's signal embedded in the fact that you've even gotten to that level. And so way more people respond to your updates, are willing to take meetings. And it's like, oh yeah, you're raising a $30 million Fund 3? Okay. Like you must have something going for you. I don't necessarily need to take this through a warm intro. Whereas when you're raising an $8 million Fund 1 or $5 million Fund 1, people are like, how did you get my email address?
Yeah.
Like,
who are you?
What?
Unsubscribe, please.
Yeah.
Please stop. I get a lot of those. Please stop. Oh, that's funny. Well, what are you excited about looking forward? Next five years or so?
I think
maybe 10.
From a firm perspective, like to me, like the most fun and most enjoyment I get out of like doing this job is just seeing companies grow, going to offices and seeing like them filled with people, because that's like one of the things that you think you take for granted in this is like, wow, you're actually like part of job creation. Like you largely only interact with founders and CEOs in this role. You don't oftentimes get to meet the people that those companies hire. And so like 2 weeks ago, I went to an office warming for a company that's like they just opened a new office and they have 30 employees, right? Like, and meeting people that just started working there, 2 months ago, because they raised a Series A and they're ramping up and hiring. Like, to me, that's like one of the most rewarding parts of doing this job. And like, I'm excited to see how these businesses like actually grow from a sustainable perspective, not just raise follow-on capital and get markups. That's nice too, but it's an outgrowth of like actually like building enduring companies. From a tech and sort of invested perspective, to me, I'm most excited to see some of the, I kind of want to see like the shakeout of this wave of the last 2 years. Not because I think stuff is overvalued, which I do think it is, but more to see like what actually sticks around as core products and core businesses that end up shaping the way that technology gets built over the next 5 to 10 years, versus which things were kind of shiny objects, flashes in the pan that.
Yeah. What are the
were,
rack spaces versus the Amazon, the
yes,
AWSs?
yeah, exactly. And
Yeah.
what do new types of companies actually get built in the long run because of the stuff that stuck around? I had a very interesting like line of demarcation between Fund 1 and Fund 2, which was the launch of ChatGPT, which basically bifurcated the end of Fund 1 and the deployment of Fund 2. And so if you look at the profile of Fund 1 companies versus Fund 2 companies, it's markedly different, just because that's what founders were attracted to building and drawn to building. And so I think, since over the last 3+ years of deploying Fund 2, things again have obviously shifted wildly again. And so I'm excited to see how that plays out in Fund 3. I think even more so, it'll have even more marked sort of effect on the makeup of Fund 4, 3.5, 4 years from now.
Fascinating. Well, let's wrap up with a quick wrap up, rapid fire. Which founder taught you the most about resilience?
Well, I'm not going to call out either of these founders by name, but I've had two founders who, one whose spouse was diagnosed with cancer and he's healthy and recovered fine, but was diagnosed with cancer in the middle of building her company, and another whose daughter was diagnosed with cancer and she's on the road to recovery, but still like not 100% there. And both of those founders have been, to me, it's a reminder that like life is happening around these companies, right? Like, as much as you as an investor are just thinking about, all right, I'm underwriting this person as in their experience and their skill set and all these things that we've talked about on this call, like there's all sorts of other stuff going on, and life doesn't just stop because you're trying to build $1 billion business. And so those two founders just sort of like, and by the way, both companies are doing extremely well, like insanely well, despite all of the really hard emotional, mental tolls that both of these entrepreneurs had to contend with and are contending with. And so to me, like there's all sorts of other definitions of resilience, but to me, like those two women stand out in terms of their level of determination, like above and beyond any founder that I've worked with.
What's a belief about pre-seed investing you've reversed in the last 5 or 10 years?
I think probably early traction doesn't matter. Like I used to overweight early traction, I think, a lot as a bias that I had. And now I don't write it off entirely, but I'm way more sort of self-aware of that as implicit bias that I have when evaluating a company is if they have early traction, I think more highly of them. And I just needed to learn through prior mistakes or seeing how companies sort of progressed post that initial pop, that some things are a false positive or some things just aren't sustainable or enduring. And so it's one of the things I think about as a solo GP who doesn't have, quote unquote, checks and balances on like my decision making, is like I need to be hyper aware of how I think about underwriting investments and any biases that I have, and making sure that I strip those away. And this is one that I've kind of learned to sort of more easily notice and reconcile since I started doing the job.
Yeah, I'm the same. I think I used to overweight traction as well, and now it's a little bit of the kaleidoscope of everything. What's the most helpful question a founder's ever asked you?
That's a great question. I don't know if it's necessarily the most helpful, but it's a question that I don't think enough founders ask. Somebody was just like, I think you need to put founders on the spot or put investors on the spot more. It's a tenuous balance as a founder to do that, but like really digging in on like, why did you take this meeting? Why are you excited about what we're building? Like making versus just like going through the motions. all right, this is what Looking Glass is. Great, you do your pitch. Let me ask some questions. Make a decision. Right, like it takes a certain level of like charisma and confidence for a founder to start a meeting and a conversation like that. And some investors might completely take it the wrong way and be very like pissed off. Those are probably investors you don't want to work with. So this might be a good way of weeding them out. But when a founder asks me that, and it's happened, doesn't happen frequently, but it's happened a bunch, enough that I remember the time, like not so much that I remember specific times, but there
It
are,
always catches you off guard. I do get that question,
yeah,
every probably once a month or a
yeah,
couple times a month. I'm like, oh,
yeah.
well,
I'd say it's once a month, a
yeah,
couple times a month that I get that. And I'm like, okay, like this is going to be an
thoughtfulness.
engaging
Yeah.
conversation. I'm going to be on like, this isn't just a founder who's like in lean back mode. It also sets the tone for probably how their process is going. If they feel like they can, sort of start the conversation with me answering questions about the company or the space. And so I always think that's a dynamic that I like, I appreciate. It feels like I'm being like, cold called in like a business school class or something.
It's a good sales technique too. Like what are your pain points right now? Why'd you take this meeting? I love that. Is it a negative signal when both the founders are on the call?
I don't think it's a negative signal if both founders are on the call. To me, it does potentially lead to a vulnerability though, because I've definitely had times where the CEO just like completely deferred into answering or was talked over. And to me, that's a red flag. And so it's just know that some people are going to be extremely turned off by that.
I think the CTO should just be building and the CEO should be fundraising.
Well, on a first call, it's one thing, right? Like just CEO, but like a lot of times, like I want to talk to the rest of the founders, right? Like on a second conversation, third conversation. And so if you have two non-technical founders that are clearly like really driving things, like I just backed a company, two non-technical founders, both showed up to the call. I know they've taken a lot of their pitches together. They are very complementary to one another. It's a core part of the story and narrative. So I don't have a problem with that. Non-CEOs reaching out to schedule meetings for reaching out to investors. That to me never works.
Yeah. What are you having your associate do this? Your CEO?
Yes. Or COO, co-founder, like just all sorts of, nonsense. And that I don't take those meetings. I don't take.
Especially in pre-seed. Maybe an A, that'd be fine. But deck, demo, or conversation on the first call?
All of the above. Whatever, to me, it's whatever is going to help you do your job the best. I do not like when a founder says, so how do you like these meetings to go?
I don't like that either.
I've had just own the discussion. Just you need to own the room, even if the room is you staring at your laptop. Like get what you need out of me as the investor to have context, which I'm happy to do. And I always keep it super brief because the story is way more interesting coming from the founder than from me. But if you want to walk through a deck, walk through a deck. If you just want to do a conversation, do a conversation. If getting to a demo quickly helps position the business and the product better, do that. But like, do not defer to the investor. Like you're the storyteller. You know what your strengths are as a fundraiser and someone pitching. So just do that.
Yeah. What's a contrarian view you hold about building a venture firm in today's environment?
That everyone should do it. Like there are too many funds. Like why does everyone need to have a fund? Why does everyone need to spin out? Why can't people just work for somebody else for a while and then learn and then maybe go and start a fund? Right? Like too many people in their early to mid 20s who think that they should be doing venture and just raising funds off of access. That's my sadly that feels contrarian and maybe it's going to get me canceled or something. But yeah, way too many.
You'll get an X flame storm.
Yeah, way too many young early to mid 20s something starting funds who have never had jobs, who have never worked at another venture fund before.
What's a book, essay, podcast, or talk that influenced how you think about founders?
I don't know that I have one in particular that has really like struck me. I mean, like I kind of don't like reading about my job or listen. Like I don't listen to, the only podcasts I listen to are when people I'm friends with are on them or I happen to be on. But like
reasonable.
I don't listen to All In. I don't listen to TBPN. I listen to Bill Simmons. I listen to stuff that takes me out of my day-to-day work zone. I read stuff that's just pure fiction, maybe some historical fiction, non-tech related.
Yeah. You've crossed over to the mature VC that, is just like, because we work so hard. I know we get a bad rap, but we actually do work really hard. And so It's actually really awesome where I live. I live east of Sacramento on Lake Folsom, and nobody cares about VC out here. Nobody knows what I do. They're like, "What is that?" You're like Shark Tank. And so it's great. Like as soon as I leave my little home office, nobody cares. I'm not in the San Francisco or New York City like hubbub of like, how much did you raise? I'm just
Yeah,
chilling by a lake with deer in my front yard.
yeah, I don't know. I like watching my Philadelphia Eagles and my Duke basketball team, and I kind of whatever. I plug in for way too many hours per day and week, and I'm tethered to my tethered to this digital leash. And when I don't have to take pitches or fundraise or support portfolio companies, I want to take a breather and disconnect. I mean, I think honestly, like I learned a lot of that from like Chris, right? Like he moved out of San Francisco to Truckee and disconnect. He's like, look, I'm going to be a better investor, removing myself from
That's like an hour from me. That's not that far.
the chaos of San Francisco and the Valley, and think more clearly. And I think, like I don't know, I kind of, if I were 25 or 26 doing this when I first started, like I went to every event. There was the performative nature of being busy and hustling and all that stuff. And I've got 3 kids, and I'd much rather do spending that excess time running around with my kids on their bikes than trying to consume one extra incremental 20 VC pod. No offense, Harry.
No offense, Harry.
Again.
Oh, you've been on 20 VC? That's awesome. Yeah, I like Harry. He's such a workaholic. He works so hard.
Yeah,
But he's like in his late 20s, right? He's like 28 or something now. So
yeah, he's late 20s. He doesn't have kids.
Yeah, grinding.
Some of the stuff is a young person's game.
Yes, this has been an awesome conversation. I learned a ton and really enjoyed it. Thanks for coming on.
Yeah, thanks for having me. This is great.